Welcome back, everybody. Today, we're going to be diving into some high-yield dividend stocks.
Oh, nice.
Yeah.
I like it.
Specifically, those that pay out monthly.
Oh.
Yeah. So, instead of waiting every quarter for your dividend check,
Yeah.
you get a little bonus hitting your account every single month.
Makes sense.
Yeah. So we're using an article from the Motley Fool as our guide for this deep dive.
Okay.
It's called Looking for Passive Income. These 3 high-yield dividend stocks cut you a check monthly.
Catchy title.
Right. It was published just last week on November 9th, 2024.
Very recent.
Yeah, so fresh off the presses. And, it's not just about a little extra cash each month.
Right.
Dividend-paying stocks can have a major impact on your long-term returns.
Yeah, absolutely.
In fact, the article mentions a 50-year Hartford Funds study
Okay.
that found that dividend-paying stocks delivered more than double
Wow.
the annual return compared to non-dividend payers.
That's huge.
Yeah, that's big. All right, so the Motley Fool picked out 3 real estate investment trusts, or REITs, for this monthly dividend strategy.
Okay.
And I know REITs are known for those juicy dividends,
Yeah, for sure.
but what makes them so different from other stocks?
Well, legally, they have to distribute at least 90% of their taxable income back to shareholders as dividends.
Oh, okay.
So for income-focused investors, that's
Yeah.
a big draw.
Makes sense. All right, so let's jump into the first REIT on our list. Agree Realty, ticker symbol ADC.
Okay.
Now, whenever I see those standalone retail stores,
Yeah.
like grocery stores, home improvement places, even those tire shops,
Right.
I always wonder, who owns all those properties?
Yeah, good question.
Yeah.
That's a good question.
So,
Well, in a lot of cases, it's REITs, like Agree Realty.
right.
Yeah, they buy, manage, and lease out these properties.
Gotcha.
But what sets Agree Realty apart is its focus on tenants with strong credit ratings.
Oh, okay. That's smart.
We're talking almost 70% of their tenants have investment-grade ratings.
Wow.
These are companies considered very financially stable.
So less risk of them skipping out on rent payments.
Right, exactly.
Makes sense.
Yeah, and when you look at their tenant list, you see names like Walmart, Tractor Supply, Dollar General, Best Buy, CVS.
Oh, wow.
These are household names,
Yeah.
the kind of businesses that are deeply ingrained in our daily lives.
Yeah, for sure.
Yeah.
So it sounds like they're pretty good at picking reliable tenants.
Yeah, I think so.
And I'm guessing a high occupancy rate is key for a REIT's success.
Yeah, absolutely. A high occupancy rate means more rental income coming in.
Yeah.
And Agree Realty boasts a 99.6% occupancy rate
Wow.
with an average lease term of nearly 8 years.
That's incredible.
That's a powerful combination of consistent income and long-term predictability.
Those are some impressive numbers.
Yeah, they are.
But I do have a question.
Sure.
Retail has faced some challenges with the rise of online shopping.
Right.
Is that a concern for Agree Realty?
It's a valid point and it's something investors should definitely consider. However, Agree Realty has strategically focused on essential businesses like grocery stores and pharmacies. Those are the kinds of places people need no matter what's happening with the economy or shopping trends.
That's true. You can't exactly order milk or prescriptions online.
Right.
No, not easily anyway.
Not easily.
So Agree Realty is essentially betting on those everyday needs,
Yeah,
which seems like a pretty safe bet.
I think so, yeah.
And their commitment to steady dividends is clear.
Definitely.
They've got low debt, a reasonable payout ratio, and a history of consistent growth through property acquisitions.
Yeah.
It suggests they're focused on sustainable growth and rewarding shareholders over the long term.
I agree.
All right. Agree, Realty is definitely off to a good start.
Yeah.
Now let's move on to our next contender, Realty Income, ticker symbol O.
Okay.
They've been in the commercial real estate game for over 5 decades.
53 years, to be precise.
Right, 53 years.
Yeah.
That's got to be some kind of record.
It might be.
What does that kind of longevity tell us about Realty Income?
I think it speaks volumes about their ability to generate consistent cash flow through thick and thin.
Wow.
They've weathered recessions, market crashes, all sorts of economic storms.
Yeah.
That kind of track record can provide investors a lot of peace of mind.
That's sure. Experience counts for a lot, especially when it comes to investing.
Yeah.
And they're not just a small operation either. Realty Income owns over 15,450 properties.
Wow. That's a lot.
Right.
And not just in the U.S.
Oh, right.
They've got properties across the U.S., the U.K., and even Spain.
Wow.
Yeah, it's a global portfolio, which adds another layer of diversification.
Okay, now that's impressive.
Right.
And who are they renting these properties to?
Like Realty, they have a knack for choosing those essential, reliable businesses.
Okay.
Their tenant list includes Dollar General, 7-Eleven, Walgreens, FedEx, and CVS.
Again, a lot of names we see every day.
Yep.
So Realty Income seems to be following a similar strategy of focusing on businesses deeply embedded in our daily lives.
Exactly. It's a strategy that has served them well for over half a century.
Yeah, makes sense. Now, the article mentions something called triple net leases. Is that something unique to Realty Income?
Not necessarily unique to Realty Income,
Okay.
but it's definitely a key part of their strategy.
Okay.
With a triple net lease, the tenant isn't just responsible for the rent, they also cover property taxes, maintenance, and insurance.
Oh, wow. So Realty Income doesn't have to worry about those extra costs.
Right.
That sounds like a pretty sweet deal for them.
It is. It creates a very predictable and stable income stream for Realty Income,
Right.
which can be a big plus for investors seeking consistent dividend payouts.
Yeah, okay, that makes sense. But I do have one concern.
Okay.
The article mentioned that a whopping 91% of Realty Income's portfolio is in retail properties.
Yeah.
Isn't that a bit risky given the challenges facing retail these days?
It's definitely a point worth considering, but remember, they're focused on a specific type of retail. Those essential businesses we talked about earlier. Grocery stores, convenience stores, drugstores, dollar stores.
So it's not just any retail. It's the kind of retail that tends to be more resilient during economic downturns.
Precisely. And they've spread their risk by ensuring no single tenant accounts for a huge chunk of their rental income.
Oh, okay.
Their largest tenant, Dollar General, only represents 3.4% of their total rent.
Oh, wow. So they've got a nice cushion built in.
Yeah.
All right, Realty Income is starting to look pretty good.
Yeah.
But I'm curious about our final REIT Stag Industrial.
Sure.
What makes them stand out?
Stag Industrial has carved out a niche in a very interesting sector, the U.S. industrial property market. They focus on owning and leasing out warehouses and distribution centers.
Now, that's an area I don't hear much about,
Yeah.
but it sounds like it has a lot of potential.
It absolutely does. With the continued growth of e-commerce, the demand for warehousing and logistics space has exploded.
Oh, that makes sense. You can't have all those online purchases without somewhere to store and distribute them, right?
Exactly. And Stag Industrial isn't limited to just one region. They've got a pretty impressive footprint with properties spread across 41 states.
Wow.
Yeah, that geographical diversification helps to mitigate risk associated with regional economic ups and downs.
So they're not putting all their eggs in one basket, so to speak.
Right.
I like their approach. What about their tenants? Are they renting to those big-name companies we've been talking about?
They do have some well-known companies like Amazon Soho Studio and even Tempur Sealy International.
Okay.
But they also lease to lesser-known but still essential businesses like Eastern Metal Supply and American Tire Distributors.
It sounds like they've got a good mix. So tell me, how has Stag Industrial performed since they entered the scene?
They've experienced incredible growth since going public back in 2011. They started with just 93 properties and have expanded to a whopping 573 properties today.
Wow, that's a massive expansion.
It is.
And from what you're saying, it sounds like they're in a great position to continue that growth.
They are. A Grandview research report estimates that the global warehousing and distribution market will grow at a compound annual rate of 8% through 2030.
So Stag Industrial is tapping into a sector that's not only booming right now, but is projected to keep growing for years to come.
Exactly. And with a reasonable payout ratio and a solid track record since their IPO, Stag Industrial is definitely a REIT to watch.
Okay, we've covered 3 very different REITs so far,
Yeah, we have.
each with its own unique approach to generating income.
Ah.
All right, welcome back. So I'm ready to dig a little deeper into these REITs. We've talked about their pennant portfolios, their strategies, even their longevity.
Yeah.
But what about the numbers? Like, what should we be looking for to really evaluate their financial health?
That's a great question. And it's where things get really interesting.
Okay.
When it comes to REITs, you can't just look at net income like you would with a traditional company.
Okay.
You need to look at something called funds from operations, or FFO.
Okay, FFO, that's a new one for me.
Yeah.
Why is FFO so important for REITs?
Well, think about how REITs operate. They're constantly buying and selling properties,
Right.
which leads to a lot of depreciation on their books.
Okay.
Depreciation is a non-cash expense, meaning it doesn't actually reflect a cash outflow.
So it's kind of like an accounting quirk
Yeah.
that can make their profits look lower than they actually are?
Exactly. FFO adds that depreciation back in, along with a few other adjustments, to give you a more accurate picture of the cash flow a REIT is generating from its operations.
Okay.
And cash flow is king when it comes to dividend payments.
Ah, that makes sense. So when I'm researching a REIT, I should be looking at their FFO per share, not just their earnings per share.
Precisely. FFO is a much more relevant metric for evaluating a REIT's ability to pay and sustain dividends.
Gotcha.
And speaking of dividends,
Yeah.
another crucial metric is the payout ratio.
Okay. Payout ratio.
This tells you what percentage of a REIT's FFO is being paid out as dividends.
Okay, so the lower the payout ratio, the more room they have to increase dividends in the future.
Exactly. A lower payout ratio generally indicates a more sustainable dividend policy, as it leaves the REIT with more cash flow to reinvest in its business, pay down debt, or weather any unexpected storms.
So what would you consider a healthy payout ratio for a REIT?
It can vary depending on the specific REIT and its growth prospects,
Okay.
but a payout ratio below 80% is generally considered to be in a safe zone.
All right, that gives me a good benchmark. Now let's imagine I'm looking at my own portfolio,
Yeah,
which admittedly needs some work.
we've all been there.
Yeah, it's a journey.
It is.
So say I've got a mix of stocks, bonds, maybe some mutual funds.
Okay.
Where would these monthly dividend-paying REITs fit in?
That's the million-dollar question, isn't it? And there's no one-size-fits-all answer. It really depends on your individual financial goals, your risk tolerance, and your overall investment strategy.
Yeah, of course. But let's assume for the sake of this discussion that I'm looking for a way to smooth out my returns and generate a more consistent income stream.
Okay?
Could these monthly dividend payers help with that?
They absolutely could. Think of it this way. Most stocks pay dividends quarterly if they pay them at all.
Right.
That means your income comes in chunks 4 times a year. But with monthly dividend payers, you're getting a little bit of income every single month.
It's like creating a regular paycheck from your investments.
Exactly. And that regular income can have a psychological benefit as well. It can provide a sense of stability and make you less likely to panic and sell your investments during those inevitable market downturns.
That's a great point. I know I've definitely made some emotional investment decisions in the past.
Yeah, me too.
Having that steady stream of income could help me stay more disciplined and focused on the long term.
Exactly. It's about creating a portfolio that not only meets your financial needs, but also aligns with your emotional needs as an investor.
I like that. So strategically incorporating these monthly dividend payers could potentially add a layer of resilience to my portfolio.
Precisely. It's like adding shock absorbers to your car. It might not make the ride perfectly smooth, but it can certainly help you navigate those bumps in the road.
Okay, I like that analogy.
Good.
Now, we've talked a lot about the potential benefits of monthly dividend payers.
Right.
But I'm sure there are some risks to consider as well.
Yeah.
What are some things I should be wary of?
That's an important question. Remember, every investment comes with risks.
Right.
REITs in particular can be sensitive to interest rate changes and economic downturns.
Okay, so if interest rates rise,
Yeah.
REITs might have to pay more to borrow money, which could eat into their profits and potentially affect their ability to pay dividends.
That's right. And during an economic downturn, people might cut back on spending, which could hurt retail REITs like Realty and Realty Income.
Okay, so it's crucial to do my due diligence and understand the specific risks associated with each REIT before I invest.
Absolutely. Look at their debt levels, their tenant diversification, their exposure to different geographic regions and sectors. The more you understand about a REIT's business, the better equipped you'll be to assess its risk profile and determine whether it's a good fit for your portfolio.
And if I'm ever unsure, it's always a good idea to talk to a financial advisor, right?
Absolutely. They can help you assess your risk tolerance, define your investment goals, and develop a personalized plan that aligns with your overall financial situation.
Great advice. Now, before we wrap up part 2, I want to touch on something you mentioned earlier.
Okay.
The growth potential of these REITs. Is it realistic to expect both high dividends and growth from these companies?
That's a great question, and it's one that a lot of investors struggle with. Can you really have your cake and eat it too?
That's what I'm wondering. Is there a trade-off between dividends and growth?
Well, it's not always a simple either situation.
Yeah.
Some REITs can achieve a good balance between paying out attractive dividends and growing their business.
Okay, so it's not impossible to find REITs that offer both income and growth potential.
Exactly. And that's where careful research and analysis come in.
Yeah.
You need to dig into their track record, their management team, and their growth strategies to assess their ability to deliver on both fronts.
So it's all about finding those hidden gems.
Yeah.
Those REITs that are well-positioned for both consistent income generation and long-term growth.
Precisely. And those gems, as you call them, often lie in understanding the nuances of each REIT's business model and the dynamics of the sectors in which they operate, for example.
Okay, so we've talked about FFO payout ratios and the importance of due diligence, but I'm ready for the big reveal. Which one of these REITs stands out as the most promising for someone looking to build a solid monthly income stream?
I was wondering when you'd ask, but remember, there's no single best investment. It all depends on your individual goals and risk tolerance. What might be a perfect fit for one investor could be completely wrong for another.
Of course. But let's imagine I'm that investor who values stability, consistent income, and long-term growth potential. Who would you put your money on?
Well, if I were in your shoes, I'd be seriously considering Realty Income.
Okay.
Their 53-year history of consistent dividend payouts is remarkable. They've navigated all sorts of economic climates and still managed to reward their shareholders.
Yeah, that's true. They're like the marathon runner of REITs, steady and reliable.
Right.
And their focus on essential businesses seems like a smart strategy, especially in today's uncertain world.
Exactly. People still need to buy groceries, fill their prescriptions, and grab those last-minute necessities, regardless of what the economy is doing. And Realty Income has built a portfolio that caters to those everyday needs.
Plus, they've got that global reach, which adds another layer of diversification.
Yeah.
They're not just reliant on the U.S. market.
It's true. And let's not forget those triple net leases.
Right.
They shift a lot of the operational costs and responsibilities to the tenants, giving Realty Income a very predictable and stable income stream.
Okay, I'm sold on Realty Income.
Right.
But what about the other two REITs, Agree Realty and Stag Industrial?
Yeah.
Are they worth considering at all?
Absolutely. Agree. Realty is a solid contender. Their focus on investment-grade tenants and their impressive occupancy rate speak to their commitment to stability.
And I love that they're actively growing their portfolio through acquisitions. They're not just sitting back and collecting rent checks.
Exactly. And Stag Industrial is a fascinating play on the booming e-commerce sector. Their focus on warehouses and distribution centers puts them right at the heart of this massive growth trend.
Yeah, I'm starting to realize there's a whole universe of REITs out there.
There is.
Each with its own unique story and investment potential.
That's the beauty of it. There's something for everyone. And the more you explore, the more you discover about different industries, market trends, and investment strategies.
It's like a treasure hunt.
It is.
Now, before we wrap things up, I want to circle back to the idea of building a resilient portfolio. We've talked about how monthly dividend payers can provide a sense of stability and help smooth out returns, but how do they fit into the bigger picture of long-term financial planning?
That's a great question. It's important to remember that monthly dividend payers aren't a magic bullet. They're just one piece of the puzzle.
So it's not about putting all your eggs in one basket, so to speak.
It's exactly. A well-diversified portfolio should include a mix of asset classes, including stocks, bonds, real estate, and possibly even alternative investments.
And within each asset class, it's important to diversify further. So even within REITs, I wouldn't want to invest solely in retail properties.
Precisely, you'd want to consider different sectors like industrial healthcare or even data centers.
Wow, there's so much to learn. I'm starting to realize that investing is an ongoing journey, not a destination.
That's a great way to put it. It's about constantly learning, adapting, and refining your approach as your financial goals and circumstances change.
And that's what I love about the deep dive. We're not just giving financial advice, we're encouraging people to think critically and explore different investment ideas.
Exactly. We're planting seeds of curiosity and empowering people to take control of their financial future.
Well said. I think we've covered a lot of ground today, from the basics of REITs to the nuances of building a resilient portfolio. Any final thoughts before we sign off?
Just this. Remember that investing a marathon, not a sprint focus on the long term. Stay informed and never be afraid to ask questions.
Great advice. And to our listeners, thanks for joining us on another deep dive. We'll be back soon with more fascinating explorations of the financial world. Until then, happy investing.